Hello everyone, I am Miss Priyanka Sanjay Latte, lecturer at Moa Education Society's Mula Rural Institute of Pharmacy Sone. In this presentation, I am going to discuss topic that is financial statements. This topic we will discuss for second year D Pharmacy students. Content of presentation. Definition. Advantages of financial statements. Limitations of financial statements. Profit and loss account. Preparation of profit and loss account. Points worth noting in profit and loss account. Analysis of financial statements. Methods of financial analysis. Advantages and disadvantages of ratio analysis. Firstly, we will discuss definition. After the preparation of the trial balance, the management of a business enterprise proceed to get the financial statements prepared. The purpose of preparing financial statements is to enable the management to have a periodical review of the progress made by the enterprise and deal with first, the present status of investment in the business, and second, the result achieved during the period under review. The definition of financial statement. The term financial statements means the two statements prepared at the end of the accounting period of the enterprise, which the balance sheet in bracket statement of the present financial position bracket complete and profit and loss account in bracket income statements bracket complete is also called as the financial statements, and the two statements together are called the financial account in traditional account language. Next point, advantages of financial statements. The accounting information given in financial statements is made of by first management. The management can review the up-to-date progress made by enterprise and then decide about necessary course of action to be taken in future. Second, creditors. The creditors can decide about extending, maintaining or restricting the flow of their credit to the business. Third, shareholders. On the basis of financial statements, the shareholders are in a position to judge the future prospects of their investment and thus decide either to sell or continue with the ownership of their shares in the firm. Fourth, employees' unions. The employees group or unions can find out the present financial conditions of the firm from the financial statements and are thus able to decide whether the firm is in a position to pay higher wages, bonus, etc. Next point, limitations of financial statements. First, the profit shown in profit and loss account and the financial position revealed by the balance sheet cannot be exactly true, since these statements are only interim reports. The exact financial of the business can be known only when the business is either liquidated or sold. Second, the balance sheet is affected by various factors such as fixed assets, going concern concept, and conventions like conservatism and consistency, such as the balance sheet does not reveal the exact financial position of the concern as is claimed by it. Third, many items in financial statements are influenced by personal judgment. Hence, The quality of statements therein depend on the competence and integrity of those who prepare it. Fourth, financial statements record and reveal only those facts which can be expressed in terms of money. Next point, profit and loss account. Profit and loss account reveals the net profit earned or net loss suffered by the firm in course of its business operations during the accounting period. It is prepared at the end of the financial year of the business. The main purpose for which a profit and loss account prepared is to ascertain net profit or net loss from business operations. The net income of the current year can be compared with that of the previous years, and deviations in income of different periods may be analyzed to ascertain the factors responsible for such deviations. Such an analysis is helpful in controlling expenses incurred in running the business enterprise and in sale of goods, and thus eliminated wastage. Next point, preparation of profit and loss account. On determining the gross profit and gross loss from the trading account, the gross profit is recorded on the credit side of the profit and loss account, and gross loss is recorded on the debit side of the profit and loss account. After this, the other incomes or gains such as rent received, interest received, commission earned, discount received, etc. are credited. The expenses or losses such as salaries, rent, advertisement expenses, business expenses, printing, stationery, etc. are recorded on the debit side. The grand total on both debit and credit sides are obtained. If the grand total no credit side is more than on the debit side, it shows a net profit. If the grand total on the debit side is more than on the credit side, it shows a net loss. The net profit or a net loss, as the case may be, is taken to the capital account of the proprietor, while net profit is added to the capital account. Net loss is deducted therefrom. Next point, points worth nothing in profit and loss account. Various types of items are included in a profit and loss account. A detailed description of some of these items is given below for better understanding as to how a profit and loss account is prepared. First, salaries. Salaries paid to employees are debited to the profit and loss account. The term salaries and wages is treated as salaries and is debited to profit and loss account. However, the items wages and salaries is treated as wages and is debited to the trading account. Second, rent. The amount of rent paid is shown on the debit side of the profit and loss account. However, in case of rent received, it is an item of income and as such it will appear on the credit side of the profit and loss account. Third, discount. Discount is of two types. First, trade discount and second, cash discount. In that first, trade discount is given on the bulk purchase and bulk sales. It is deducted from the amount of purchase and sells before they are recorded in the books. Hence, no further treatment is given to trade discount. And second, a cash discount is given to creditors or customers in order to encourage the prompt payment of dues. When discount is received for creditors, it is considered as income and is shown on the credit side of profit and loss account. When discount is allowed to customers, it is regarded as an expenses and hence it is debited to the profit and loss account. Fourth, commission. To increase the sales, agents are appointed on commission basis. The commission so paid is an indirect expenses and is debited to the profit and loss account. The commissions paid on the purchase of goods is debited to the trading account. Fifth, printing and stationery. Printing and stationery include all expenses relating to printing bills, invoice, registers, files, letterheads, handbills, office stationery, etc. It is an indirect expenses and is debited to the profit and loss account. 6. Advertisement. To boost sales of products, suitable publicity is necessary. It is an essential expenditure for any business. Hence, it is debited to profit and loss account. Since it is an indirect expenses. 7. Carriage outwards or freights outwards. These expenses are incurred by way of transportation charges in respect to goods sold. It is treated as an indirect expenses and is debited to the profit and loss account. 8. Bad debits. An irrecoverable debits is known as bad debits. This is a loss item for business and hence appears on the debit side of profit and loss account. 9. Repairs. Repairs to plant, machinery, building, etc. are indirect expenses and are therefore debited to profit and loss account. 10. Drawings. Drawings represent money or goods withdrawn by the proprietor from business for his personal use. This is debited to capital account. For example, premium paid on his life insurance policy is treated as drawings and is deducted from the capital account. It is not to be taken to profit and loss account. 11. Income tax. In case of a trader, income tax paid is treated as a personal expenses and is therefore deducted from capital account. However, in case of companies or partnership firms, income tax is debited to profit and loss account. 12. Loss or gain on assets sold. Sometimes a business enterprise may sell its assets such as furniture, machinery, building, etc. in course of its business operations and thus may incur a loss or make a profit on its sale. The loss on the sale of a fixed asset is treated as a review loss and is debited to the profit and loss account. The profit made on sale of a fixed asset is treated as a review gain and is credited to the profit and loss account. 13. Loss by fire, draft, etc. Loss due to draft, etc. is considered as an abnormal loss and is debited to the profit and loss account. Next point, analysis of financial statements. Financial analysis is a process of evaluating the relationship between component parts of financial statements to obtain a better understanding of the financial position and performance of a firm. The steps involved in financial analysis are as follows. First one, select the information relevant to the purpose of analysis from the financial statements. Second one, arrange the information in a way so as to highlight significant relationship. Third one, interpret the relationship and draw relevant conclusions from them. Financial analysis is useful to different groups in society. However, the purpose of analysis varies from one group to another. For example, the management of a firm is interested in the overall performance of the firm. The shareholders and investors are interested to the earning per share. The debenture holders want to know the capital structures and earning positions of the company, whereas the banks and other short-term creditors are interested in the compositions of current assets and current liabilities of the firm. Next point, methods of financial analysis. Financial analysis can be made by the following methods. First, comparative financial statements. These statements contain figures of two or more consecutive years which give a comparative view of the financial performance of a firm. A comparative profit and loss account gives expenses and reviews of two consecutive years. Similarly, a comparative balance sheet contains the amount of assets and liabilities at two different points of time. For example, on 31st March 2014 and 31st March 2015. Such statements reflects the nature and trade of changes in the financial performance of the company. Under the Companies Act 1956, the companies are required to give figures for the current years as well as the previous year in their profit and loss accounts and balance sheets. Second, common size financial statements. In these statements, figures are converted into percentages to some common base. For example, in the profit and loss account, the sale figures is assumed to be 100 and all figures are expressed as a percentage of sales. Similarly, in the balance sheet, the total of assets or liabilities is taken as 100 and all other figures are expressed as percentage of this total. Third, funds flow analysis. It reveals changes in the working capital position of an enterprise. It indicates the source from which the working capital was obtained and the purpose for which it was used. Fourth, ratio analysis. It is the most popular method of financial analysis. Moreover, it is simple and more informative. The term ratio refers to the numerical relationship between two items. A ratio by itself does not reveal much, but its comparison with a similar ratio of the past or of a similar firm is very useful in judging a performance and the financial position of the enterprise. A financial analyst can use various types of ratios for different purposes. The various accounting ratios are: first, liquidity ratios; second, solvency ratios; third, activity ratios; fourth, profitability ratios, and fifth, miscellaneous ratios. We will discuss one by one. First, liquidity ratio. These ratios, consisting ratio analysis of the short-term financial position, are used to measure the ability of the firm to meet its current obligations. The following two ratios come under the head. First one, current ratios, in short CR. It is also called working capital ratio and is the most widely used for all analytical devices based on the balance sheet. It matches the current assets of the firm to its current liabilities. Current ratios is equal to current assets divided by current liabilities. In that, the generally current ratios of 2 is considered satisfactory. A current ratio of 2 means for every 1 rupees of current liabilities, 2 rupees of current assets are available to pay them. A satisfactory current ratio enables a firm to meet its short-term obligations and thereby ensures the smooth operations of business. The second one, quick ratios. It is also called acid test ratio. It is used to measure the ability of the firm to convert its current assets quickly into cash in order to meet its current liabilities. Quick ratio is equal to quick assets divided by current liabilities. Quick assets means the current assets which can be converted into cash immediately or on a short notice without decreases in value. Quick assets include cash and bank balance, securities, and debtors. Quick ratio is more useful than current ratio as it provides a more rigorous test of the firm's equity. Generally, a quick ratio of 1 is considered satisfactory. Second, solvency ratios. It is also known as leverage ratio. Solvency means the liabilities as and when they mature for payment. It also indicates the financial risk to long-term creditors. It measures the relationship between owners' funds and creditors' funds. The greater the proportions of owners' funds, the higher is the solvency of the firm. Solvency is measured by following two ratios. First one, debit equity ratio, in short D by E ratio. And second, debit to total capitals. We will discuss one by one. In that, the first, debit equity ratio, in short D by E ratio. It is used to measure relative claims of creditors and owners. Debit equity ratio is equal to long-term debit divided by shareholders' equity, where shareholders' equity is equal to equity share capitals plus carpals plus preference share capital. Debit equity ratio is an important tool of financial analysis for evaluating the financial structures of a company. A high debit equity ratio means the shareholders' stake in the company is low. A low debit equity ratio indicates a higher stake for shareholders. The appropriate debit equity ratio will depend upon the nature of the company's earning. And the second one, debit to total capital. Debit to total capital is equal to long-term debit divided by permanent capital, where permanent capital is equal to shareholder equity plus long-term debit. Third one, activity ratios. It is also known as efficiency ratios. These are intended to measure the efficiency with which the firm manages and utilizes its assets. An activity ratio is a test of the relationship between sales and various assets of a firm. Some of the important turnover ratios are: first, inventory turnover ratio ITR. Second, capital turnover ratio. We will discuss one by one. First, inventory turnover ratio. It is also known as stock turnover ratio. It is used to measure the firm inventory management. The ITR can be calculated by any one of the following two formula. Inventory turnover ratio is equal to cost of goods sold divided by average inventory. And the second formula, net sales divided by average inventory. A high inventory turnover ratio indicates the underinvestment in inventory and involves the risk of the firm becoming out of stock. Similarly, a very low inventory turnover may indicate overinvestment in inventory, which results in higher cost. Thus, a firm should have a proper inventory turnover. And the second one, capital turnover ratio. This ratio measures the relationship between the sales and the capital employed in the business. That is, capital turnover is equal to sales divided by capital employed. Fourth, profitability ratios. These are designed to highlight the end results of business activity. So, these ratios are useful to measure the operating efficiency of the company. The various ratios covered under these are: first, gross profit ratio; second, net profit ratio; third, return on investment. We will discuss one by one. In that, first, gross profit ratio. Gross profit means sales minus cost of goods sold. Gross profit ratio is equal to gross profit divided by net sales into 100. Gross profit depends upon the selling price, sales volume and cost. A high gross profit is a sign of goods management and indicates that the total cost of the sales is relatively low. It may also indicate that the selling price of goods has increased without the corresponding increases in the cost of goods sold. The other possibility is that the cost of goods sold might have declined without a corresponding decline in the selling price of the goods. A low gross profit ratio is due to increases in cost of goods sold or decline in selling price due to inferior quality of the products or lack of demand, etc. Second one, net profit ratio. The ratio is also known as net profit margin. It measures the relationship between net profit and net sales. Net profit ratio is equal to net profit divided by total sales into 100, where net profit means gross profit minus operating expenses. Net profit ratio is helpful in determining the efficiency with which the operations of the firm are being managed. Third, return on investment, in short ROI. The overall profitability of an enterprise can be measured by relating its net profit to its investment. There are three different concepts of investment which are given below. Return on assets is equal to net profit after taxes divided by total assets into 100. Second formula, return on capital employed is equal to net profit after taxes divided by capital employed into 100. The capital employed means the long-term funds supplied by the creditors and shareholders of the company. The third formula, return of shareholders' equity is equal to net profit after taxes divided by equity share capital into 100 plus preference share capital plus return earning. Return on investment is a useful measure for judging the overall efficiency of an enterprise. It indicates as to what degree the long-term funds of the business have been properly utilized. The next fifth type, miscellaneous ratios. The following are some of the ratios which are not covered under the main categories. The first is earning per share. It is used to measure the amount of earning against each share. Earning per share is equal to net profit after tax divided by total number of shares into 100. Second one is dividend per share. It is used to measure the amount of dividend paid against each share. The formula, dividend per share is equal to total amount paid to shareholders divided by outstanding number of shares. Third one, dividend payout ratio. The ratio is utilized to evaluate the shareholder return. Formula, dividend payout ratio is equal to dividend per share divided by earning per share. Fourth one, dividend aid ratio. It is utilized to evaluate the shareholders' return in relation to the market value of share. Formula, dividend aid ratio is equal to dividend per share divided by market value of share. Fifth one, earning year yield ratio. The ratio is also used to find out the return given to shareholder in lieu of the market value of the share. Formula, earning yield ratio is equal to market value of share divided by earning per share. Sixth one, interest coverage ratio. It is also known as debt services ratio and is very useful to test the debt servicing capacity of the firm. Formula, interest coverage ratio is equal to net profit before deduction of interest and taxes divided by fixed interest charges. Next point, advantages of ratio analysis. First one, it helps in easier and the better understanding of profit and loss account and balance sheet. Second one, the accounting ratios of one firm can be compared with those of others to judge the relative financial positions of different firms. This helps the management to detect the weakness and strengths of the firm. Third one, ratio analysis enable the firm to judge whether its financial positions is improving or deteriorating over the years. Fourth, it helps in future planning. Next point, disadvantages of ratio analysis. First one, the ratios are based on the information contained in the financial statements. The ratios become unreliable if the data given in financial statement is not accurate and up to date. Second one, due to change of price level from one period to another, the assets acquired at different periods are shown in balance sheet at different prices. As such, accounting ratios based on those figures cannot be compared. Third one, ratios are useful indicators only when they are compared with similar ratios of other firms. It is difficult to compare the firms because they may different accounting periods or different composition of assets. Fourth one, ratios are only a post mortem of what has happened. They do not reveal the future events. Fifth one, ratio reflects only the financial aspect of business. Next point, difference between the profit and loss account and balance sheet. In that the first point of profit and loss account. In profit and loss account, the nominal accounts are shown, and in balance sheet, the personal accounts and real accounts are shown. In that the second, the aim of profit and loss account is to provide information regarding net profit and net loss, and in balance sheet, the aim of balance sheet is to know the financial position of the business. Third one, it is a ledger account giving information about debits and credits, and in balance sheet, it is only statements of assets and liabilities. In that profit and loss account, the fourth point, it is an account so two words to and by are used, and in balance sheet, it is a statement and the words to and by are not used. The fifth point, in profit and loss account, the balance of the profit and loss account indicates the profit and loss, and in balance sheet, the total on both sides of a balance sheet is always the same. The sixth point, in profit and loss account, the account shows the profit and loss made by the business as on a fixed date, and in balance sheet, it shows the financial positions of the business enterprise on a fixed date. Thank you.